Fed meeting bombshell sent stocks and bonds sharply lower. Yesterday's Fed meeting dropped a 25 basis point rate cut as expected. But why did bond yields go straight up? And did Powell say that QE is coming back? What did Powell say that set stocks and bonds sharply lower? Now, before we get into it, it's important to remind everyone that inflation has been above the Fed's 2% target for 240 weeks. 56 months or 4.5 years. In fact, the 4 year average over the past 4 years, inflation has averaged 2.4% above the Fed's target of 2%. I don't know how 2% price increase are stable prices, which is actually the Fed's mandate. I don't understand how prices going up 2% every single year, your wages getting devalued by 2% every single year is somehow stable prices, but that is what they consider stable prices. And we can see the 4 year average has been 2.4% above their own 2% target. We are currently at 3% inflation, which is 50% above their long run target of 2%. And again, we have remained above inflation anytime in this chart that is denoted by a red line. You can see, of course, the moving average shows the vast majority of the time, going back to the early 90s, we have been above their target. Also important to note, normal people do not feel inflation as a year-over-year rate of change. They feel it as a cumulative rise in prices, which is denoted by the CPI index, not as a year-over-year rate of change. I also overlaid ISM services prices component pushed forward by 3 months, and we can see it's a pretty good predictor for what CPI is going to be. And as you can see, it is reflecting higher inflation in the future. Now, getting into the highlights from the meeting, there were two notable dissents, one to the upside for no cuts and one for larger cuts, that, of course, being Myron. He, of course, also, yet again, mentioned tariff-related inflation risk. I would ask where a goods inflation is only 1/10 of that 3% CPI. Only 1/10 of it is coming from goods, as we can see from the latest CPI inflation report. He also mentioned preventing entrenched inflation. I would point him to consumer inflation expectations, which remain quite elevated, 4.7%, which is above where CPI is coming in at 3%, and notably over double the Fed's target of 2%. And of course, once again, Powell mentioned the two-sided risk of maximal employment on the labor side, but then stable prices, which is low inflation on the other side. Reiterated a neutral stance rationale that you have to, when you have two policies, your two policy goals equally at risk, you ought to be at neutral. And they believe the neutral interest rate is lower. And of course, that is why they cut, because they believe the labor market is more of a risk. And of course, I would remind people, while we're not getting unemployment data because of the government shutdown, 4.3%, while it is higher than it was, say, 2 years ago, it is still a very, very low level. And I would also point people to this. The rate of change of the unemployment rate looks very characteristic, like we are coming out of a recession. If you note, the rate of change of unemployment starts to peak and then head lower, basically at the tail end of a recession, which is exactly what we are seeing now. Of course, no recession has been declared. He also reiterated a data-dependent approach. And of course, there were calls to pause in terms of easing. And this is what sent stocks and bonds sharply lower. We'll get to that in a second. But I did want to mention that he did mention repo rate stress. If you have been following the channel, we've been talking about this exhaustively, going all the way back to August. And Jerome Powell actually brought up SOFR. He brought up SOFR spreads and repo market stress. What he said, signs have clearly emerged that we've reached that standard. In money markets, repo rates have moved up relative to our administered rate, which you could think of as reverse repos, how we normally look at it here, or IORB. And we have seen notable pressure on selected dates, along with more use of our standing repo facility. Of course, we know the standing repo facility, that is one thing we've been flagging, an increasingly frequent usage of that emergency Fed backstop. He mentioned that as well. In addition, the effective federal funds rate has begun to move up relative to the IORB. We have also been flagging that. That is seen in white. Now, there's a bit of a glitch with TradingView because we got a Fed rate cut is not actually as severe as the chart looks today. SOFR is still above the discount window rate for yesterday, but is not as severe as TradingView is not updated with the Fed rate cut, and therefore a 25 basis point reduction should be applied to these various interest rates. So I thought it was very notable that he mentioned repo stress, and that gets into what we will talk about toward the end of the video is QE coming back. But what sent stocks and bonds sharply lower was this comment. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not a preset course. Now, of course, the market had been pricing in a very, very high likelihood of more rate cuts, not only a rate cut at this meeting, which we did get, but more rate cuts into the future. And as we can see, yesterday's SPY did move pretty sharply lower. It looked like it was going to fill the gap, but we are getting that today rather than yesterday. It did rally in the close. We can see VIX up, Bitcoin down, gold is rallying, and of course, bond yields have gone straight up. So why is that? Well, here we're looking at Fed Watch, and of course, we can see the probability of an interest rate cut for that December meeting was quite elevated, and that probability is moving lower, as we can see here. So as those cuts get priced out from the bond market, if the bond market had been pricing in a high likelihood of more rate cuts than we already got, then when the Fed or Jerome Powell signals that those future rate cuts aren't going to actually come, you're going to get a pricing out of those rate cuts with bond yields moving sharply higher. And sure enough, as we can see, here's yesterday, by the way, here's the Fed meeting. The cut was announced here. That was largely expected by the bond market. That had been priced in. But then as soon as Powell became hawkish, we can see that all bond yields move sharply higher. And again, they moved higher in a relatively contained sort of way. If we look at the 30 minus the 2, this yield curve spread, taking the 30-year yield and subtracting the 2-year yield, we can see there was some amount of flattening, but then a bear steepening where yields were moving higher, but again, they were moving at the fastest rate at the long end of the yield curve, this bear steepening here, again, on the hawkish Fed, but generally speaking, over the past week or so, the 30 minus the 2 has remained relatively flat. Here, by the way, is getting into that question about QE. So what they said, they're going to reinvest. Remember, they have been engaged in quantitative tightening. And in quantitative tightening, they are letting agency debt or mortgage-backed securities roll off the balance sheet and not reinvesting the principal payment that they get at the end of the maturity for those securities. Well, what they announced is that they're going to, after December 1st, reinvest all that principal back into Treasury bills. And we know that the Treasury Department has been issuing more and more Treasury bills. Now, remember, the Fed balance sheet is their asset. What are some of their liabilities? Well, the Treasury General Account is a liability, currency is a liability, and bank reserves are a liability. These are just some of the liabilities, but arguably the main ones. So what they are going to do, as we can see, the pace of quantitative tightening has been slowing, but what they're going to do is basically stabilize the balance sheet and start to grow it at the rate of GDP, at the rate of the overall economy. And Andy Constant, I think, gave a pretty good summary of this. What he said, balance sheet expansion is money supply expansion or money printing and could be done via large-scale asset purchases, which is the true definition of QE. But ignoring semantics, balance sheet expansion is QE-ish, but now let's talk about scale. During the period of time in which QE and QT were not occurring over the past 40 years, reserves, remember that is 1/2 of M0 or the monetary base, grew on average by 2.8%. M2, which is the broad money supply, including checkable deposits, time deposits, savings accounts, that sort of thing, grew by 5.5%. Now, that is the actual growth in the money supply, 5.5%. We've noted that many times. M1, not very commonly used, but that grew by 5.2%. He says the Fed increasing its balance sheet slowly over time at a rate of 3 to 5%, consistent with real GDP, is normal. It's not QE. It's not QE, which moves the money supply by 200% increase and 50% down episodically. It is just normal. Normal debasement of a fiat currency, normal upside for hard assets, normal like 2 to 5% a year boost, nothing like what QE does. And we can see, of course, in 2020, what he's talking about when it comes to QE. We can see that, for example, bank reserves went from 1.6 trillion to 3.3 trillion. The Fed balance sheet here went from 4.2 trillion all the way up to $9 trillion. So it is a distinction that is probably important, but it is, as he mentioned, QE-ish. Now, here are bank reserves as a share of the M2 money supply. And this is a chart I've pointed to many, many times because what it shows is part of that structural break that occurred in 2008. It used to be that the Fed and the Treasury and kind of the vol controllers, the government institutions, were not responsible for the vast majority of the money supply. In fact, banks, private banks, created the vast majority of the dollars in the system. However, that changed in 2008, where we can see a sharp uptick. We went from about 0 or 1% bank reserves as a share of M2 money supply up to a peak here in 2021 of 18%. So increasingly, the Fed and to some degree the government, the federal government, are stepping in to fill some sort of hole that was created during 2008, where private banks stopped lending money into the real economy, and we started to get more and more of this kind of hyper financialized mess where they are just artificially stimulating through things like bank reserve increase, which again is money printing. It is new money creation. Bank reserves, again, being one half of the monetary base. That is increasingly clear from looking at M0 relative to M2, or as we can see, bank reserves as a share of GDP. Over here in pink, by the way, I added a little note about how this will work mechanically. It kind of depends whether or not this ends up causing actual consumer price inflation. It'll almost certainly cause asset price inflation. Whether or not it causes consumer price inflation is kind of dependent on the flow or lack of flow between various different parties. Bank reserves will be increasing again at a rate relative to the rate of growth of the overall economy. But again, the net effect here is that generally speaking, there will be more printed money. So whether or not it's QE, whether or not the scale of it is on the order of magnitude of, say, 2020 or 2008, it is certainly not that large, but it is QE-ish, even as Andy Constant, again, veteran of Brevin Howard and Bridgewater, very, very smart guy when it comes to macro, even he admits it is QE-ish, but it is not full-blown outright QE. It is normal debasement, as he calls it. And again, it can cause inflation, and it most likely will. Again, inflation is already 3%. It is probably headed higher. Again, if we go back to the chart here that showed inflation relative to ISM services prices pushed forward by 3 months, that's indicating inflation is coming. Again, I want to remind people, tariff inflation, Jerome Powell was asked about this and pressed on like, how much tariff inflation are we talking about? He said it was only about 20 basis points. So all these people that going back to April have been calling for 100 basis points or 1%, 2%, 3% spike of inflation due to tariffs. Even the chairman of the Federal Reserve himself, number one, we're not getting that. We have had tariffs in effect for a long time now. We are only getting 31 basis points of goods inflation, number one, already. The data shows that. Number two, even Jerome Powell says that if we were to get more tariff-related inflation, it would only be about 0.2%. Most people will not notice that. Again, so it's really important to point that out because the mainstream media is making way too big of a deal over that. I think the biggest deal should be made over this, fiscal dominance. They are cutting interest rates so that the government can afford to service the debt. Inflation has been moving higher for 5 months and is at the highest level going all the way back to January January, it is 3% inflation, and they are cutting interest rates. In fact, inflation has been above the Fed target for 4.5 years, and they are cutting interest rates, not only at the last meeting, but back last year, going into the election in late 2024. They were also cutting interest rates with inflation well above their target. Again, that fiscal dominance, it was baked in the cake due to the due to the debt dynamics. This was always going to be the what happened, but I think that is really the story to focus on. Inflation is 50% above their target and has been for 4.5 years, and they are cutting interest rates. So, of course, a little bit of a hawkish tone sent bond yields sharply higher and stocks sharply lower. But in general, I think this is really the main story. So, anyways, hopefully that was helpful, and I'll catch you in the next one.